SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner at Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Roman Basi, who's a tax attorney, a transactional diligence provider, and an expert on all things accounting and tax. So we're going to hear from him a little bit on key items to look out for in the transactional process, all surrounding your tax diligence and tax structuring. So Roman, thanks for joining. I'll let you take it from here.
Thanks for having me, Sean. Really appreciate it and excited to talk some tax today. Always the highlight of my day is when I get to give a presentation or to speak on some taxes. Excellent.
Well, why don't you kick it off by giving us a little background on yourself and on Basi and Basi, and we can kind of take it from there.
Sure. So I've been in the field for about 28 years now. I joined my father back in 1997. He and I are both attorneys and CPAs. I'm a real estate broker and title insurance agent as well. We work all over the country in the merger and acquisitional field, specializing in privately held companies. I've done some publicly held company transactions as well too, but mainly specializing in the privately held merger and acquisitional world. Again, all across the United States. We work in all 50 states, working with private owners and private investors. It is my entire day. In fact, just this morning, I've been working on at least 2 or 3 different clients of mine that have had investments in companies that had some issues creep up over time. And I'm working on a very large $39 million transaction. I worked till 10:30 last night, and I'll be working on it most of the day today as well. So that's a little bit about our firm as well. We're headquartered in Illinois. I'm sitting here in my Florida office today. We do have other lawyers and other CPAs that work in our firm. It's not just me, although I am the owner and the managing partner of the firms these days. So that's a little bit of a background about who I am and what we do.
That's great. And seeing so many transactions obviously gives you a great eagle's eye view into the various items you need to focus on from a tax diligence perspective and kind of structuring. So why don't we start by giving a high level on the importance of tax diligence and tax structuring, both for buyers and investors?
You know, I think a lot of people miss sometimes what diligence even is. And when we just start talking about due diligence or tax diligence in a transaction, I use the term discovery when I'm talking to my clients. I'm saying, look, when you're doing the tax due diligence on a transaction, you're doing a discovery of a lawsuit. You're saying, hey, what is going on in this company? What is their structure of their company like? What are the tax implications of this deal? What are the tax liabilities involved in this deal? There's so much that goes on in the world of due diligence and what we're discovering. I mean, first of all, it's support. When we're doing tax due diligence, we're supporting the transaction. We're supporting what we call the quality of earnings analysis that a buyer may be doing in the transaction. And we're really starting and saying to ourselves, okay, first of all, what is the best way to look at this company and to purchase into this company or to invest into this company? Is it going to be best to buy assets? Is it going to be best to invest in the stock of the business? Then we'll look at things and say, what's the best corporate structure? And if I'm an individual investor or an individual buyer looking at buying a company, what's the best corporate structure for me from a tax standpoint? And that's one of my first steps as a tax attorney. Going to look at a company and say, should we be setting up our buyer or our investor, even an investor, even if you said, Roman, we're going to be investing into a company that's already operating and running, what's the best tax structure for the investor, not just potentially a buyer? Is it a C corporation? Is it an S corporation? Is it coming in as a limited liability company? So many people get it wrong by saying to me, well, Roman, I'm going to form a limited liability company and open up a business or invest into a company. I always have to stop when I'm giving a presentation and tell people, do you really understand what limited liability company means from a tax perspective and from a legal perspective? When you decide to be a limited liability company in a due diligence or in a tax diligence, you are telling me you really don't know what you're doing, because a limited liability company still has to elect a tax matter, how they're going to file their taxes, what is going to be their tax entity classification. Are they going to be a C-Corp, S-Corp partnership, or a disregarded entity? A limited liability company still has to elect that status. And do people realize what a limited liability company stands for? A limited liability company means what it says. You have limited liability, limited personal liability in that entity. Why? as an investor or a buyer, would you ever want any personal liability? So when someone comes to me and says, I want to buy a company or I want to invest in a company and I've formed an LLC to do this, I already know they probably don't know what they're doing, because I would recommend to them, unless they're investing into some type of real estate venture, which is where I would promote an LLC, I'm going to most likely recommend to them, look, we want to be a C-Corp or potentially an S-Corp. And then we're going to go a little bit farther during our due diligence. I'm going to say to them, what is your intentions with this company? How long do you want to be in this business? Are you long-term? You want to retire and pass this on to someone else or your family? Or are you short-term? You want to build it up after a couple of years and maybe 4 or 5 years later, sell it. So then we look a little deeper at the tax structure and say, look, do we want to be a C corporation? Structured as what we call a 1202 qualified small business stock corporation, which just on a high, we could talk about this for an hour, but on a high level to those listening today, a 1202 C corporation is a qualified small business stock that can be set up initially by a buyer or an investor. The stock is held for a minimum of 5 years, and then the stock can be sold tax-free up to $10 million of gain per shareholder, or 10 times the unadjusted basis of the stock, whichever is greater. We usually use $10 million per shareholder. Now, some of this will change depending upon when we set up the C Corp, what tax law is in play at the time. The new tax law has some impact to this already. So we always want to look at, or when did you do you already have a C corporation that you've set up and you're going to use this C corporation to invest or to buy into a company? So we start looking a little bit deeper. If we say we want to be an S corporation, we will look at the QBI, the qualified business income deduction. That's where you have 20% of the profits of the S corporation that are not taxable to the company. So we set you up as an S corporation so that maybe you buy a company as a QBI S corporation and you're not paying tax on 20% of the profits. And the new tax law that we now have makes that change permanent. So going forward, if it's a proper qualified business income set up as a flow-through entity, you're not paying tax on 25% of the profits. There are even more complex structures we look at in the due diligence of taxation. We may look at something called an F reorganization. And we look again, on a high level to the listeners today, if a seller is selling a company and wants to retain some equity in the company, and or maybe you, the buyer, have a different setup of investors that you wish to bring along with you, or a larger number of investors, we may look at something called an F reorganization. Those two things I highlighted just now, a seller wants to retain some equity. A buyer maybe has a foreign individual that wants to invest, or another type of entity that wouldn't classify under some of our standard rules. We look at these things called F reorganizations. In the very beginning of this section, I said to you, hey, we want to look at whether we want to buy assets or stock. Sometimes we need to do both, and we can do both. We can actually buy assets as a buyer of a company and get a step up in basis to those assets so we can depreciate them immediately when we buy a company, and we can buy the stock of the company at the same time. It's a hybrid structure called a 338H10. So I'm throwing out all these things to all of you listeners today saying, look, we've got all these tax diligence things to look at: structure, C Corp, LLC, S Corp, internal revenue codes, 1202, F reorgs, H10s. It's all these things that we look at when we're looking at the tax due diligence. Then finally, we get down, when we're looking at the due diligence, we look at some of the state level issues. So those are what I talked about a minute ago. That's federal and Internal Revenue Service and things like that. Then I'll look at some of the state issues, what we call tax clearance issues. What does the company you're investing or buying in, do they owe taxes? Are they cleared on taxes? When you buy a company or invest in a company in most states, you have to apply for what's called a tax clearance certificate. Guys, these take time to get in. If you apply for these tax clearance certificates as a buyer a week or two prior to closing or prior to investing, you're not going to get the tax clearance certificate in time. You're going to get it after the closing. And what if you find out after the closing, man, this company has a large tax liability with the state, and now you've got a problem because I don't want to be on the hook for that tax liability, and I've entered into this transaction with this company. So that's something that we look at as we're breaking down some of those diligence items. And we try to attack that issue very early on in a transaction. Sean, that's just a small snippet of where I come in on a tax due diligence discussion of investing or buying into a business.
Even that high level summary you gave illustrates the complexity and the importance of having an expert focus on these things. In my career, I've seen so many different ways of structuring reps and warranties and indemnification baskets and all that stuff. And a lot of times, to your point on tax clearance or just other kind of tax liabilities, it can be such a common sticking point to say, hey, any kind of tax liability that arises post close, that's something that often should be taken from the indemnification basket. But a lot of times we see sellers saying, hey, it's yours now, you should
Yeah.
have figured out before. So how often do you see kind of the balance of those two sides of the coin?
Yeah, it's part of the negotiation of that definitive documentation, especially when we're looking at those indemnification provisions, those tax representations. What is the owner representing in the definitive agreements that they know or should have known about the tax liability? Does the tax liability follow the assets or not? In most states, it'll follow the assets. We're trying to do all this diligence so that we avoid this dispute post closing of, hey, we did have a liability pop up, and now we've got to figure out how to deal with it. In a recent transaction we did a few years ago in the state of Illinois, we were very surprised at this. The tax clearance certificate, the business owed no taxes whatsoever. But what the state of Illinois did was on the tax clearance certificate, they estimated what the next quarterly tax payment owed was going to be, and they put that on the tax clearance certificate. That alone caused everybody to have a headache because why are we estimating the next quarterly tax to the old owner on a tax clearance certificate, which those certificates usually require the buyer to withhold that amount from the deal until that's paid by the seller, when that wasn't going to be the seller's liability anyway? So again, then we get into those provisions of, is this covered under the indemnification? Is this covered under the tax rep? Is this underneath the basket? Is this above the cap? What are we dealing with? So I've been doing this 28 years. And the reason why we look at all of these issues in the diligence and in the structuring of the deal is so that we do not have these issues after closing. And honestly, in all my years, I can count on less than one hand the tax issues that have arisen post closing on a matter. But I say that this morning we received IRS letter from one of our clients who was a defense contractor. We sold his company about a year ago in Florida, and the IRS has said that he owes taxes on a late payment of some payroll tax. It's a large amount, it's $50,000 or more. And this issue, even though we sold the company a year ago, the client is still receiving letters from the Internal Revenue Service regarding this amount. We even escrowed this amount at the closing. So these tax issues do happen. They happen sometimes even when you plan for them. Like I just said, we escrowed some money for this at closing. So the buyer has money held back from the deal to pay this liability if the seller loses his argument. So these things do happen, they do pop up. But if we're drafted correctly, if we looked at it in due diligence right, we drafted it correctly, we planned for it, at least we know who's responsible and how we're going to attack the liability. So that's really important when we're looking at these diligence issues. And really, there's one more thing too. You got to look at when you're doing diligence for a buyer or an investor. As I said, I want to know what their plan is, how long they're going to hold it for. But on the seller side too, because sometimes a buyer has to enhance the deal, we want to look at what the post-closing ideas are for a seller. Are we buying real estate? And can we do it, or is there real estate in the deal? And can we implement some 1031 exchanges or educate our sellers on that to help them through the deal? As a buyer and investor, if I can help my seller save on their taxes, sometimes I'm negotiating a better price for my buyer. So I'm looking at things like qualified opportunity zone investments, charitable remainder trusts. We're working on a deferred sales trust right now with a potential seller of a company, and the buyer has to be a part of a lot of those discussions. We're looking at pre-planning, due diligence during the deal, and we're also looking at what's going to be done when the deal is closing. What can the seller do after the deal, and how can we help them achieve their goals and potentially lower the value here for the buyer?
Great. Sounds like there's really kind of two core sides, right? There's the mitigation of any potential liability post-close, which is very tied into drafting, very tied into reps and warranties and escrows. And then there's the how do we structure things to maximize the value for both sides? That's kind of the carrot, right? There's the avoidance of the stick, and there's the, you know, finding the biggest carrot out of things. Is that kind of a fair way to chalk it up?
Absolutely. I mean, that goes into one of the things that we produce, which one of the items that my firm produces, and I tell my clients this, or even my potential clients this, that really their accountants and their CPAs should be producing a product like this for them. And if they don't, then that's not a merger and acquisitional accountant. And it's something that we call our tax minimization analysis. It's one of the services that our firm offers. And I'll tell you, it shows them all of what you just mentioned. Our tax minimization analysis, we call it our TMA. What that is really a flow chart. It's a flow chart for both sides. Now, normally we're drafting it for the seller, but there are times when a buyer will draft it, or a buyer again will help their seller draft it. And we're looking at, first of all, what is the total? We're looking at a waterfall. It's a waterfall of the entire transaction down to the penny of what a seller is going to walk away with in a transaction. And then we're going to look at that post-closing effect to say, okay, we've calculated what's going to be in your pocket after the closing. What do you want to do afterwards? So we start with a selling price, and we say, what all goes into the selling price? What adjustments are in there? Do you have a working capital adjustment? Are there closing costs? Is there a brokerage commission? So now we have this adjusted selling price. That's the first step. The second step is where we create a structure. This is for the buyer for the most part, but for the seller for tax purposes. And we say, okay, we're going to create a structure now for tax purposes. Is it an asset sale? Is it a stock sale? Is it a hybrid sale? Are we going to use, we could talk about this a little bit later, but are we going to use goodwill? Are we going to use personal goodwill to get around some double taxation, things like that? So we create the tax structure for the parties. Now we can tell the seller what their taxes are, but we're not done. So we have this new net cash number. Then we look at things that are not part of the taxation of the deal, like the payment of liabilities. When a buyer or an investor says, I want the liabilities paid off at closing, that's not a deduction of the sale for the seller. So we got to show that payment of liabilities after the taxes are calculated. We're still not done. Is there a consulting agreement or an employment agreement? That's ordinary income tax. Is there a non-compete? That's ordinary income tax to a seller. Is there a lease? Is there an earnout? We don't like the words earnout. A lot of buyers and investors like to use the words earnout. Know what we're doing from a buy side. If we tell a seller we're going to give them an earnout or anything like that, that's ordinary income to a seller. That's good on the buy side because we can deduct that right away. But on the sell side, that's ordinary income. So sometimes we adjust that and we make that what we call a purchase price adjustment. Now we can take that ordinary income and sometimes turn some of that into capital gain, still deductible to our buyer and over a period of time, depending upon what assets we put it to, but it then becomes capital gain to our seller. Then we're done. We have that final number on our TMA, and then we can look at that post-closing investment matters for the seller. So you're right. It's very twofold. And our TMA puts that all together. It says, look, this is the deal. This is the structure, and this is what the seller is going to net and walk away with if we do this together. And then here's the second side of it. What does the seller want to do behind the closing to offset some more taxes, pay taxes, and kick that can down the road a little bit? That's our TMA. And any accountant that is in the M&A world with their client can produce something like that. Because I don't like a deal where I get into and a buyer calls me and says, Roman, the seller doesn't want to do it because they said their taxes are going to be 40% or 40, a random number. I want to be able to show a seller exactly down to the penny what they're going to walk away with if we do this deal at this price or at this structure. I'll give you an example. An example I'm not too happy about. Got a broker I've worked with for my entire career, 28 years, and they're getting ready to sell their business. And we get a call from the buyer asking me what I think of the structure. And they're presenting the structure to me. And the structure is all based on what they call the royalty payment to the seller. Well, when I hear the words royalty payment, and I know from the buy side, I immediately know to the seller, that's all going to be ordinary income. So my initial reaction to this is, here's a broker that has worked in the M&A world my entire career, at least. So probably a lot longer than 28 years. And now they're going to sell their business all for ordinary income. Of course, I don't like hearing that. So, but that's an example of when a buyer or an investor may come to me and say, Roman, here's the structure. Does this work for us or not? And I show them on a TMA what the effect of that is. And then we can work from there and we can hopefully modify the deal and get a workable plan together for both parties.
That's a great breakdown, taking things from kind of your gross purchase price all the way to what the net amount actually is and all the potential hurdles in between. And it's interesting how tax structuring can have a huge impact on the buyer based on things you talked about, like using goodwill to create a step up and then depreciation, or whether it's, as you pointed out, kind of an asset or a stock deal, which has implications for then the seller as ordinary income or capital gains. It sounds like a lot of value gets created for the buyer at the point of the transaction. And where the risk occurs is post-close potential liabilities that may have been missed or that get created due to structuring. We could talk a bit about how you structure around some of that stuff in a bit, but vice versa for the seller, there's often a question of how much, of course, how much tax are they going to have to pay at close? So it's all about minimization at close for them. But then post close, there's a lot of strategies you can do again to kind of reduce that burden. It sounds like and actually create value. So it's almost a gives and takes there on pre close versus post close for each side.
Absolutely. It really, when we look at the structure of the taxation for that buy side, we're looking at maximizing the tax benefits when we close and how do we structure the deal? Do we have write-offs? Do we need write-offs right away? Does the buyer need them right away? Did we mark up the assets to fair market value or did we buy them at book value? That's what we're creating in that tax structure. We're looking at the same time to make the deal happen. So we're trying to account for the seller's taxation and trying to minimize their effects, but trying to get the buyer what they're desiring when they're walking into that company to say, okay, I bought this company and I know at the beginning, or if it's a startup company and we're not as worried about early profits, well, then we're not as worried about those early write-offs. So then we can make it a little bit easier on the sell side to minimize their tax implication because we're not as worried about those write-offs. That's why that tax analysis is so crucial to the success of a transaction. I can't tell you, again, I've been in the business 28 years now. We've been doing these TMAs on almost every single transaction over the last 10 years. And that has been one of the largest keys to my success over the last couple of years. 2-3 years ago, we did about 300 million in transactions. Last year, I think we were over the $200 million mark. It was a little slower of a year. And this year, now that the new tax bill has come out, I worked till 10:30 last night. It is going bananas right now.
Yeah.
We have a new tax bill. Everybody's pulling the trigger. They're ready to work on their deals again. It's all good. It's just that everyone has to understand that this is a huge, important piece that you have to take carefully and seriously and have all the right information. Because if you miss this piece, this can really impact the success of your business going forward.
Yeah, and there's 2 points there that I want to touch on, and then it would be good to talk a bit more about the new tax bill. But the 2 items that constantly come up in just conversation and both on the risk and minimization side of things are bad S-Corp risks. You talked about F reorgs. So a lot of these small businesses are structured as S-Corps. And we often hear folks talking about, at least in the transactional diligence process, how do we, one, make sure it wasn't a bad S corp, and 2, how do we structure out as much liability there as we can? So I'd love to talk about that. And then second, for investors, folks who might be building a portfolio of lots of these small cash flowing businesses, how can they think through various structuring dynamics to avoid double taxation risks or maximize the benefits of QSBS, things like that? So maybe let's start with the bad S corp and then we'll go into the second one.
Yeah, the bad S corp, we run into it more often than people think, where the S corp election maybe wasn't made properly, and that becomes part of that diligence. Did the company make an S corp election? Was it made on time? And in due diligence, if you're listening and you're investing in a business, you're getting ready to buy a business, on almost every due diligence list I've ever seen from a tax perspective, it asks for the S corp election letter received from the Internal Revenue Service. Most owners do not keep a record of that letter, and you're going to get it one time. The IRS is only going to send it one time, and most owners throw it away, lose it, whatever it is, that they don't have that letter. And that letter is crucial for proving that you have an electable S status and that it was properly done. Now, if it's not properly done, there are some ways to petition the IRS, showing them a good faith reason is to say, hey, we filed it. We either didn't get the letter or we did get it and we lost the letter. There's a little bit of things that can be done where we can try to acquire the proof that the S-Corp election was made. Of course, maybe you've been filing tax returns or the seller's been filing tax returns for 5, 10, 15 years as an S-Corp and they've never had a problem with the Internal Revenue Service. We can also ask for what's called transcript. I think it's a 2501 T. Don't quote me on that. I always get the Internal Revenue Code form number. Sometimes I'll transcribe some numbers, but there's a way to request a transcript from the Internal Revenue Service on the company. And that transcript will tell us whether or not there is an effective authorized S election for the company, when it was made, when it was approved, when it became official. So sometimes we'll do that as well to prove that. So there's ways around it, but that's part of the diligence. Are they an S-Corp? Did they do it the proper way? And more importantly, with an S-Corp too, sometimes we'll want to look at who's the real owners of the business. Who's getting it K1? You may say, oh, these 3 people own it. But then I get the K1s that have been turned into the Internal Revenue Service for 10 years, and only one person is the owner. Maybe they never changed the tax return, or maybe they changed the tax return and it's 3 owners on the tax return, but we thought we were only dealing with one person because it's one person on the legal records. Or how about this? I just sold a company recently. It was an auto dealership. It was a brother and a sister, and they weren't 50-50. We found out very late in the transaction that one of them had been divorced, and the divorced ex-spouse had received 3% ownership of the business in the divorce. And we found that out because we started looking at the K1s of the business. That person's name was not on the corporate records. But when we looked at the K1s of the S-Corp returns, we saw their name on there. We said, hey, they're a 3% owner of this business. No one bothered to tell anybody. So we're looking at all these bad S-Corp elements. We switch gears and we say, okay, how do we advise people regarding watching out for double taxational elements? There's things that we'll look at. Some companies will be a C corporation. Let me step back a second. If they're an S corporation, you have to ask them the question, were they ever a C corporation? Did they convert to avoid the double taxation by going from a C corporation to an S corporation? Many of you may or may not know that you've got a 5-year window once you make that conversion. It's called the built-in gains tax. If you were a C corporation and now you're going to flip to be an S corporation to avoid the double taxation, you cannot sell the company for 5 years, or else you will be sold as if you were the C corporation and you will face what's called the built-in gains tax. And what companies fail to do is upon conversion from C to S, you are supposed to value the business and value all of the assets of the business. And the valuation gets a little deeper than that. You're supposed to even look at your inventory, and you don't just say, well, that's the value of my inventory. You're supposed to say, what's the value of the profit that you would make on that inventory if you sold it today as a C Corp, and post that as your gain to show that you have this built-in gain. And if you sell the new S Corp within 5 years, you have the built-in gain tax to pay as if you were a C Corp. That's one thing that we look at when we're looking at double taxational issues. Now, if you come to me and you say, no, Rowan, we don't want to convert, but we want to be a C Corp, but we want to avoid double taxation down the road. One thing I'm going to look at for your company is to say, do you have what we call personal goodwill? When I sell a C Corp, I can set up a C corporation. And here's what happens too. When I'm setting up a C corporation, like we talked about above, for 1202 purposes, to maybe sell your stock tax-free after 5 years, setting this up for a buyer. And the buyer comes to me and says, yeah, Roman, but I don't think I want to be able to find somebody to buy the stock of this business in 5 years. So it's going to be an asset sale and I'm going to face double taxation. One of the things that I'll look at is to say, is this a business that has what we call personal goodwill? If it does, I can sell the assets of the C Corp and I can sell the assets of the owner's personal goodwill, and I can avoid double taxation on the sale of the owner's goodwill. So even though it's a C Corp, and now they're not selling their stock, which I could sell tax-free under 1202, I can still get them mostly capital gains treatment if I use personal goodwill. What is personal goodwill? It's the goodwill of the owner. It's their name. It's their reputation. It's their working in their community. It's their relationship with their customers. We have an entire valuation system that we use to value just the personal goodwill of a C-Corp owner. And we use it a lot in transactions, and knock on wood, in my entire career, I've never had any of my personal goodwill transactions challenged by the Internal Revenue Service. And the nice thing with that is, let's just say I have a $10 million transaction and I have a buyer that's owned this company now for a while and it's been a C-Corp, and I'm going to allocate maybe 6 or 7 million of it to their personal goodwill. Well, I've gotten them capital gain treatment on that 6 or 7 million, only taxed one time, not double taxed. Those are just a couple of ways how we get around the double taxation, whether we're converting them from a C to an S and waiting 5 years, whether we're selling them their stock as 1202, or whether we're looking at personal goodwill down the road. The end result is to say to people, look, if you're buying or investing into a company, depending upon how we set it up in the beginning and how you run it, we can avoid double taxation on the back end for you.
That's really interesting. The personal goodwill one is new to me. I think we've kind of seen allusions to that here and there, but I didn't, I think, appreciate the full nuance. So for listeners, does that also, I don't believe that would qualify for Section 1202 QSBS treatment, though. Is that right? So you'd still,
Well, we don't need it. That's the benefit. If we get 1202 treatment, then potentially we've got completely tax-free treatment. And that's why we look at all these things with the C-Corp. We say, are we selling stock? Are we going to get 1202 treatment? Okay, maybe we're not selling stock. Now we're into assets. Okay, did we make a conversion? Can we make a conversion and sell in 5 years? Or can we use personal goodwill? So we have these different buckets we can plan for and look for as the years go by with these companies.
right. Okay. So it's sort of the holy grail for a seller is Section 1202. But if you can't get a stock deal, you're now into, at least let's try to maximize personal goodwill so we're not getting double taxation, an asset deal. But in the negotiation process, how often do you see kind of a seller say, hey, look, I built this C-Corp expecting a stock sale. It's been 5 years. We could hypothetically be getting zero capital gains treatment, but because you, buyer, want to structure this as an asset deal, we're going to at least have to pay capital gains. Do you see purchase price adjustments come into play where buyers would say, all right, look, we'll give you an additional X amount to compensate for the capital gains you have to pay since we're not doing a Section
Yeah,
1202
we
deal?
will. Absolutely. One of the things that I teach, I'm on the faculty of an organization where I teach the tax class. And in those negotiations like that, we will calculate the present value to the tax saving to the seller and use that as a negotiation tool. I even give the students a problem, making them work through the calculation of the present value of the tax savings to the seller to help reduce the purchase price for the buyer, to negotiate that in. That is exactly how we utilize these tax provisions. Go back and talking about what we call a 338H10. This is an S corporation purchase where we want to purchase the assets and get a step up in value so that we can redepreciate them, but we need to purchase the stock because this particular company has some contracts. That's even where we use this methodology of calculating the present value of a tax savings to a buyer, where we can give the seller a little bit more money to do a hybrid transaction. So this works both ways. This works in a C-Corp transaction where we have these tax savings to a seller, and it works in a flip transaction where the buyer is trying to get some tax benefits, and we're going to give the seller some additional money because the buyer is going to receive some additional tax benefits. This all comes down to calculating what we call the present value of that tax impact and using it for one side or the other. That's really the easy way for me to kind of say it. But yes, that's how exactly what we look at doing.
That's a competitive advantage for folks that are sophisticated buyers that understand these tax advantages and can come to the table and say, look, we can pay a higher price because we know we're going to get a nice tax benefit in whether it's goodwill, depreciation, amortization, that sort of thing, or otherwise. So yeah, I think it's a great point. One other thing I wanted to touch on before we maybe get your feedback on the new bill at the very end here, but there's some common approaches in this independent sponsor and kind of search fund world where folks are putting together C-Corps to then conduct a roll-up strategy, right? And they're qualifying those C-Corps for Section 1202. And maybe it doesn't have to be a roll-up. It can be a tech-enabled growth strategy or something similar. But the argument is this is a new C-Corp that we've started, and we took on capital, and part of that growth capital is to, buy a business to get it off on the right foot. So we see those frequently, and the pitch is, hey, this can be QSBS treatment. Just wanted to get your take on that and how you've seen that structured or any tips you have.
That as well. I think some of the tips, especially when you break down the sponsors and the self-funded searchers, are I look at what first of all with the sponsors, what symmetry are they bringing to the table? What's their experience? Have they done this before? Do they understand that code section? Do they understand the business that it has to be, the model that it has to be? So I'm looking at their experience, their track record. What is their investor base? If they're using a C corporation for this model, whether it's for 1202, whether they're doing some type of F reorganization, of course, we see a lot of those because their investor base is a little bit more broad typically. So what are they bringing in? Why are they needing this? What are they looking at? And I'm doing one right now, a fairly good sized transaction, about $36 million. There's an independent sponsor involved. And I even had an email this morning that I looked back at where an attorney 1 year ago, prior to me stepping into this transaction, had looked at the sponsor and said, how long have they been in business? They were recently formed. The entity had been just recently formed. Talking to people out there that might be independent sponsors and listening in, or you're thinking of investing in some type of an independent sponsor, that almost was a block to the transaction. I just looked at this email maybe about an hour ago that the lawyers for the were looking at the sponsor and saying, what if you acquire? You've just formed this business. So I guess you have no examples for us to look at. And you're buying into a $36 million family owned company and you want to manage this entity and try to keep some of the people. And boy, just to see the concern that this company had 1 year ago and to know where I'm at now with this transaction was a real eye opener. And that to me, those are the concerns that I would have. Those are the things that I would look for with a sponsor, is to say, how long have you been doing this? Have you done any 1202 that have been successful? Have you seen them on the back end? If you're pitching a C Corp 1202 structure, have you completed one? Have you sold one afterwards? How did it work for you and your other investors? And it's fairly similar for those in the self-funded search categories too, to say, what's your experience overall, experience in the industry? One thing that popped up today in a transaction was, where is the rollover equity going to be now from the seller to this self-funded organization? What is the class of, and I do try to flesh this out pretty early. What's the stock going to look like? What's the classification of the stock going to be? What are the other shareholder? What does that structure look like? I think that's something that our owners need to know. I looked at a letter of intent, I guess it was yesterday, for, and it was an electrical company. It's about a $9 million transaction. And they're getting ready to sign the letter of intent. And we were able to put in some of the stock classification that they're going to get into the letter of intent last night. Now I just got the feedback this morning, but that way our two owners know, and it's a husband and a wife, what they're getting out of this transaction. The more I can educate them as sellers coming in from a buyer or an investor, the better off this transaction is going to be. So those are some of the concerns that I look for in those deals. Hopefully that answers your question.
Yeah, it's great feedback. I mean, we've gotten questions before that Section 1202 is meant to be for startup companies that are fresh. So does it qualify if you're buying a new business? And I think, to your point, there's varying sort of prerequisites that need to be there for it to qualify. So it's great feedback that you have. And just to dovetail on kind of the QSBS piece, and maybe you can talk a little about bonus depreciation for us too, since that's a big topic. But the new tax bill has implications for both QSBS, Section 1202, and for bonus depreciation. And to my understanding, some of that bonus depreciation language can apply to purchases of property, plant, and equipment in asset deals. So are there strategies you're starting to see where folks can, both for investors especially if it's kind of a pass-through type structure, and for the buyers themselves that are starting to structure deals differently to maximize the impact of QSBS and bonus depreciation.
Absolutely. I mean, look at the new structure. Some of the highlights of the new tax bill, especially with the QSBS, is that there's an easing of the 5-year requirement. As you just said, it has to be. It's not that it has to be a new company, but the C corporation, the requirement has always been the original issuance of the stock. When did the issuance take place? Well, a company may not have issued stock to an investor yet. So if that investor is getting an original issuance of the stock, that's when the law is going to apply to them. And now there's an easing of the law. There's going to be an easing of the law where maybe you're only going to have to hold the stock for 3 years, depending upon all of this always depends on when the stock was issued. The QSBS law has always been, when was the stock issued? That's the law that's going to apply in your circumstance. But now there's going to be some exclusion of gain after 3 years, 4 years, 5 years. The lifetime exclusion is going to go up from 10 million to 15 million. It also this has always had a limitation. A company couldn't be a QSBS unless it had 50 million or less in assets. That threshold is going to go up to 70 million, a 75 million or less. So we're definitely seeing some benefit here to where, even from an investment standpoint, there might be some structuring to say, look, we're going to issue you some stock as an investor, and you're going to get a benefit after 3 years. And maybe there's some type of an option after maybe there's a call option, but the call option doesn't happen till after 3 years for those investors, as opposed to right away. So there's definitely some structuring now that can come along with this new tax bill. Of course, another really big highlight for the new tax bill, as we do all this planning, is the extension of the estate tax limitations. I mean, it's hard not to talk about the new tax bill without that, because here we thought we were going to have this reduction all the way down to 5 million per person, adjusted for inflation, not doubled. And of course, that didn't happen. We're now at a higher limit of 15 million, and we just see all this benefit from this new tax bill. There's a lot we can talk about the new tax bill, but I guess the end result is, yes, there's a lot of beneficial structuring that can help a buyer or investor minimize their tax impacts on the back end of these investments. It's really going to be exciting now.
All right. Well, Roman, this has been super informative. Appreciate you sharing your insights. Maybe any closing remarks, how people can get in touch.
The best way to reach out to us, our website is taxplanning.com. It doesn't get much easier than that. You can shoot us an email at info@taxplanning.com. The way I work across the country, you shoot us an email, you want to work with us, or you have a client that you want to introduce to us, usually we'll set you up with a phone call. I am on about every single one of those preliminary phone calls. Then we follow that up with how we can help. We talk to you on the call. We talk to the client. We follow that up with an email about how we can help and what our cost might be. Welcome to check us out on the website and shoot us an email again at info@taxplanning.com. And we'd love to help you or work with you.
All right. Well, thanks so much, Roman.
Thanks for having me.